right, today we're going to tackle one of the most talked about stocks on the entire planet, NVIDIA. And we're going to do it using a valuation tool that's incredibly powerful, but also surprisingly simple. So let's pull back the curtain and find out what NVIDIA's sky-high stock price is really telling us.
You know, it's the question every single investor asks themselves. You see a price flashing on the screen, but what does that number actually mean? Is the stock a bargain? Is it wildly overpriced? How in the world are you supposed to know its true intrinsic value? Well, to get to that answer, you got to understand that Wall Street is basically split into two big camps when it comes to figuring out how much a company is worth. So let's take a quick look at their playbooks.
Okay, so on one side, you have what's called relative valuation. Honestly, this is kind of like pricing your house. You just look at what similar houses on your street have sold for. For stocks, you'd compare a company's financial ratios, like its price to earnings to its direct competitors. It tells you if it's cheaper or more expensive than the other guys. Then on the other side, you've got absolute valuation. This is totally different. It tries to figure out what the company is worth all by itself, based purely on the cold, hard cash it's expected to make in the future. And when it comes to finding that true standalone value, a whole lot of serious analysts turn to one specific tool: the discounted cash flow analysis, or DCF. In theory, it's the gold standard. But, and this is a big but, it has one huge, almost fatal flaw. So the idea behind a traditional DCF is actually brilliant. It's supposed to tell you what a company is worth today based on all the cash it's going to make over its entire future. The problem is, how do you know what that future is? And that brings us to the big, messy problem with the whole thing. See, the normal way you do this starts with a massive, almost impossible task. You have to forecast a company's cash profits for like a decade out. A whole decade. Then you apply something called a discount rate to account for risk. And only after all that guessing do you finally get a target stock price. The most important part of the whole equation is basically just a prediction. And look, this quote really just hits the nail on the head. Trying to predict exactly how much cash a company will make in, say, 8 years, it's pretty much impossible. The tiniest little surprise can throw your entire beautiful model right into the trash. So here's the core issue, right? The traditional DCF method starts with a giant unknown, the future, to try and solve for an answer, the price. You're building a conclusion on a foundation of pure guesswork. But what if we could flip that entire equation on its head? This is where things get really interesting. We can use a much more elegant approach. What if, instead of us trying to guess the future, we let the stock price itself tell us what future the market is expecting? And this is called a reverse-engineered DCF. The logic is beautifully simple. It starts with something we actually know for a fact, the current stock price, and it works backward to solve for the growth that the market must be expecting to justify that price. And that little shift in perspective is just incredibly powerful. The question is no longer, what do I think the company is going to earn? Instead, the question becomes, what does the entire market, all those millions of investors, collectively believe this company needs to earn to be worth what it is today? So the whole process just gets turned completely around. We start with the known stock price, we apply our discount rate, and then we solve for the one thing we really want to know, the implied growth rate. All of a sudden, it's not a forecasting game anymore. It's an expectations game. All right, enough with the theory. Let's put this amazing tool to the test on a company where, let's be honest, the expectations could not possibly be any higher. Yep, we're going to run a reverse DCF on NVIDIA, a company at the absolute heart of the AI revolution, with a valuation that has rocketed into the trillions of dollars. Okay, so let's plug in the numbers. And remember, these are all known facts, no guesswork. We start with NVIDIA's market cap. Then we grab its most recent annual free cash flow. That's the real cash the business is generating, which is about $60.85 billion. And finally, we'll use a standard discount rate of 8%. These are the hard numbers. So with just these three simple inputs, we can reverse engineer the math. We can solve for that single, all-important unknown, the growth rate that is currently baked into NVIDIA's stock price. So here it is, the multi-trillion-dollar question. To justify its current valuation, what rate of cash flow growth does NVIDIA have to deliver every single year for the next 10 years straight? 25%. That's the answer. Let that sink in for a second. The current market price is telling us that investors, as a group, expect NVIDIA to grow its cash profits by 25% a year, every year,
for an entire decade.
Now, 25% for 1 year for a hot company? Sure, that sounds possible. But what does it mean to have to do that for 10 years in a row, especially for a company that's already one of the biggest in the world?
Well, here's the reality check. Sustaining that kind of growth for that long from such a huge starting point is, well, it's a monumental challenge. It means the market believes NVIDIA won't just continue to dominate the AI chip market, but that the entire market itself is going to keep expanding at an absolutely blistering pace. So, what can you, as an investor, take away from this? Well, a few big things. First, it's crystal clear that the expectations are just astronomically high. Second, it really spotlights the high risk, high reward bet you're making. If NVIDIA has even one bad year, the stock is vulnerable. And third, this is what's known as a prove it price. The market is demanding a decade of near perfect performance. The bottom line is this. Our analysis shows that NVIDIA stock is, quite literally, priced for perfection. The current value assumes a flawless 10-year run with almost no room for mistakes, slowdowns, or any unexpected bumps in the road.
Look, the reverse DCF doesn't give you a magic buy or sell signal. It gives you something way more valuable, a clear picture of the story you're buying into. The market has placed its bet. It's betting on a near-perfect future for NVIDIA. And now, the only question left is, do you agree with that bet?